Jai Hind everyone, welcome to my YouTube channel which is Explore Yourselves, Banking and General Knowledge, etc. Today I will discuss some potential overseas posting examination questions and their corresponding sample answers for bankers. Today marks part 10 of my Path to the Corner Office series for overseas posting examination questions and their corresponding sample answers for bankers. Under UCPDC 600, which of the following statements about irrevocable letters of credit is correct? A. An irrevocable LC can be cancelled unilaterally by the issuing bank within 3 days' notice to the beneficiary. B. An irrevocable LC constitutes an absolute engagement of the bank and cannot be modified without the agreement of all concerned parties. C. Under Article 3 of UCP 600, LCs are revocable by default unless stated otherwise. D. An irrevocable LC can be modified by the issuing bank and applicant without the consent of the beneficiary. The answer is option B. An irrevocable LC constitutes an absolute engagement of the bank and cannot be modified without the agreement of all concerned parties. My next question is the current operative version of Uniform Customs and Practice for Documentary Credits UCPDC is A. UCPDC 500 operative from 1st January 1994. B. UCPDC 600 operative from 1st July 2019. C. UCPDC 600 operative from 1st July 2007. D. UCPDC 700 operative from 1st January 2020. The answer is option C. UCPDC 600 operative from 1st July 2007. The next question is URR 725 refers to option A. Uniform Rules for Collections 1995 revision governing import bill collections. B. ICC Uniform Rules for bank-to-bank reimbursements under documentary credits effective from 1st October 2008. C. International Standard Banking Practices for examination of documents. D. Uniform rules for demand guarantees operative from 1st July 2010. The answer is option B. ICC Uniform rules for bank-to-bank reimbursements under documentary credits effective from 1st October 2008. ISBP approved on 17th April 2013 was released primarily to option A. Replace UCP 600 entirely for electronic document presentation. B. Explain how practices in UCP 600 are to be applied by documentary credit practitioners. C. Lay down mandatory stamp duty rules for use bills under LCs. D. Govern bank-to-bank reimbursement arrangements in place of URR 725. The answer is option B. Explain how practices in UCP 600 are to be applied by documentary credit practitioners. Next question is under EUCP version 2, which came into force on 1st July 2019. Supplement primarily focuses on A. Governing physical presentation of documents under traditional LC. B. Principles of electronic issuance and electronic presentations under LC. C. Replacing URC 522 for collection of export bills. D. Correspondent banks. D. Governing reimbursement claims between correspondent banks electronically. The answer is option B. Principles of electronic issuance and electronic presentations under LCs. Transfer in a transferable LC under Article 38 of UCP 600, which of the following cannot be changed when the LC is transferred to a second beneficiary? A. The expiry date of the LC. B. The last date for presentation of documents. C. The shipment period. D. The currency of the LC. The answer is option D. The currency of the LC. The next question is in a back-to-back LC arrangement, the applicant of the slave LC is A. The overseas ultimate buyer who opened the master LC. B. The first beneficiary of the master LC who uses it as security to open slave LC. C. The confirming bank of the master LC. D. The advising bank of the master LC. The answer is option B. The first beneficiary of the master LC who uses it as security to open slave LC. The next question is under a back-to-back LC, which of the following is correct regarding discrepancies found in documents presented under a slave LC? A. Branch should permit the applicant of slave LC to waive discrepancies even if the same would cause discrepancies under master LC. B. Branch must advise the presenting bank to reject documents if master LC is already expired. C. Branch must simultaneously advise the both presenting bank under slave LC and the bank that issued the master LC about discrepancies. D. Branch should accept discrepant documents if the applicant of slave LC agrees to pay. The answer is option C. Branch must simultaneously advise both the presenting bank under slave LC and the bank that issued the master LC about discrepancies. The next question is, so red clause LC differs from a green clause LC in that A. Red clause LC permits advance for warehousing and insuring the goods, while green clause LC permits advance only for purchasing and packing. B. Green clause LC provides advance only for purchasing and packing, while red clause LC also covers warehousing and insuring goods in bonded warehouse. C. Red clause LC permits advance for purchasing, processing, packing, as well as warehousing, while green clause only covers only pre-purchase advance. D. Red clause LC is irrevocable, while green clause LC is revocable. The answer is option B. Green clause LC provides advance only for purchasing and packing, while red clause LC also covers warehousing and insuring goods in bonded warehouse. The next question is, as per UCPDC 600 Article 3, which statement about revocable LCs is correct? A. Branches may open revocable LCs if the applicant specifically requests it. B. Revocable LCs are permissible but require a special clause to protect intermediary banks. C. All LCs under UCP 600 are irrevocable and branches are not permitted to issue revocable LCs. D. Revocable LCs can be opened only by confirmed banks, not issuing banks. The answer is option C. All LCs under UCP 600 are irrevocable and branches are not permitted to issue revocable LCs. The next question is, in a revolving LC, the reinstatement of the LC amount is triggered by A. Automatic reinstatement on the first of every month regardless of payment status. B. The negotiating bank's unilateral request to the issuing bank for reinstatement. C. Receipt of advice from the opening bank that the drawee has honored, paid the bills under the LC. D. Submission of fresh shipping documents by the beneficiary. The answer is option C. Receipt of advice from the opening bank that the drawee has honored, paid the bills under the LC. The next question is, stamp duty on a usance bill of exchange drawn under an export LC is computed by converting the foreign currency amount at exchange rates prescribed by A. FEDAI, the Reserve Bank of India using its reference rate. C. Department of Revenue, Ministry of Finance under Section 22 of the Indian Stamp Act 1899. D. International Chamber of Commerce, Paris. The answer is option C. Department of Revenue, Ministry of Finance under Section 22 of the Indian Stamp Act 1899. The next question is, under URC 522, ICC publication number 522, collection of bills is governed. Porval is in a bill is in a bill collection context means A. A request to represent the bill on arrival of goods rather than on receipt of documents. B. An instruction to deliver documents only against cash payment. C. A guarantee by the collecting bank that it will honor the bill irrespective of whether the drawee pays or not. D. A clause permitting extension of due date by 30 days automatically. The answer is option C. A guarantee by the collective bank that it will honor the bill irrespective of whether the drawee pays or not. The next question is for import bills received directly from overseas sellers. AD branches may handle such documents up to which amount per current RBI guidelines without routing through the overseas seller's bank. A USD 100,000, B USD 200,000, C USD 300,000, D USD 500,000. The answer is option C USD 300,000. Next question is which categories of importers can receive import bills directly from overseas suppliers irrespective of the value of the import bill? The options are A. Only proprietorship firms with satisfactory track record. B. Limited companies, public, deemed public and private limited, 100% EOUs, status holder exporters and PSUs. C. Any importer with a satisfactory credit rating from the branch. D. Only entities registered with DGFT as star trading houses. The answer is option B. Limited companies, public, deemed public and private limited, 100% EOUs, status holder exporters and PSUs. The next question is for payment of importers under the Asian Clearing Union ACU mechanism, payments must be made via ACU dollar or euro accounts for eligible transactions except in the case of option A Sri Lanka, B Bangladesh, C Nepal and Bhutan, D Myanmar. The answer is option C Nepal and Bhutan. What is the maximum period of deferred payment for trade credits in case of import of non-capital goods? Option A up to 3 years of the operating cycle, whichever is longer. B up to 1 year of the operating cycle, whichever is less. C up to 180 days from the date of bill of lading. D up to 2 years, irrespective of the operating cycle. The answer is option B up to 1 year of the operating cycle, whichever is less. The next question is import licenses for restricted goods are valid for how long from the date of issuance? A 12 months, B 18 months, C 24 months, D 36 months. The answer is option B 18 months. The next question is in case of imports under a license on FOB terms, the standard reduction applied for sea freight while endorsing the import license is option A 5% of the FOB value, B 10% of the FOB value, C 15% of the FOB value, D 20% of the FOB value. The answer is B option B 10% of the FOB value. Next question is Incoterms 2020 consists of how many rules in total? Option A 9 rules, 6 for all modes plus 3 for sea. B 11 rules, 7 for all modes plus 4 for sea and inland waterway. C 13 rules, 9 for all modes plus 4 for sea. D 8 rules, 4 for all modes and plus 4 for sea. The answer is option B 11 rules, 7 for all modes plus 4 for sea and inland waterway. The next question is under Incoterms 2020, DPU stands for option A delivered, place unloaded, seller bears cost and risk until goods are unloaded at the named destination. B delivered port unpacked, seller delivers goods at port of loading. C duty paid unloaded, buyers bears all risks after the goods cross the ship's rail. D delivered, place unpaid, seller delivers goods at named place but duty is payable by buyer. The answer is option A. Delivered place unloaded. Seller bears cost and risk until goods are unloaded at the named destination. The next question is pre-shipment finance EPC can be granted to a supporting manufacturer who does not hold export orders in his own name, subject to which of the following conditions? Option A, the manufacturer must open a separate EEFC account dedicated to the export order. B, the export house must certify that it has not obtained or will not seek packing credit against the portion of the order being executed by the manufacturer. C. The supporting manufacturer must provide a bank guarantee equivalent to 100% of the credit amount. D. The sub-supplier must be registered as a status holder exporter with PGFT. The answer is option B. The export house must certify that it has not obtained and will not seek packing credit against a portion of the order being executed by the manufacturer. The next question is, as per current RBI directives, the maximum period for which EPC export packing credit can be granted at concessional rates of interest is option A 180 days from the date of first advance, B 270 days from the date of shipment, C 360 days from the date of advance or first disbursement, D 365 days from the date of export order. The answer is option C 360 days from the date of advance and first disbursement. The next question is, if pre-shipment advances are not liquidated by submission of export documents within 360 days from the date of advance, the consequence is option A, the advance is classified as NPA with immediate effect, B, a 2% penal interest is added to the existing concessional rate, C, the advance ceases to qualify for concessional rate of interest, A, B, initio from the very first day, D, ECGC cover under WTPCG is withdrawn but interest rate remains concessional. The answer is option C. The advance ceases to qualify for concessional rate of interest ab initio from the very first day. The next question is, for merchant exporters, the normal maximum duration of individual EPC should not exceed option A 180 days, option B 90 days, option C 60 days, option D 120 days. The answer is option B 90 days. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.